And there are clear supply deficits in silver. The entire silver market is half of Nvidia's market cap, so it doesn't take a lot of new demand to push the silver price up. And the ability to manipulate silver on the COMEX or LBMA markets just isn't what it used to be 5 years ago when there was legalized price fixing in the COMEX or London exchanges. Look, there was 80,000 silver contracts short on the COMEX recently. That was a massive short position, and still silver was able to peak through. And the COMEX is running out of silver to continue to make those price manipulations. The London float of available ounces is only about 155 million ounces, and that's a day's worth of trading. So the paper manipulation, the cartel in London and New York is breaking. That's very good for silver. When you look at it at its all-time high at 50 prior to these current highs, if you were to inflation adjust those prior $50 highs, gold should be at least at 150, which I definitely see it going to that.
Silver isn't just cheap, it's historically mispriced. That's how Matthew Piepenburg of von Greyerz AG frames it. He says, from a fundamental standpoint, silver is deeply undervalued not only compared to gold but to nearly every major commodity. The gold to silver ratio still hovers around 80 to 1, meaning it takes 80 ounces of silver to equal 1 ounce of gold. Back in 1980 and 2011, when silver hit major peaks, that ratio was closer to 30 to 1. Adjust those $50 highs for inflation and silver should already be trading above $150 an ounce today. For anyone with patience, Piepenburg says this isn't a trade, it's a long-term wealth position. He also points out how small the silver market really is. Its entire market capitalization is roughly half the size of Nvidia's. That's nothing in global capital terms, which means it only takes a modest wave of new demand to move prices dramatically. The long-running manipulation through paper contracts on the COMEX and LBMA is starting to break down too. Physical inventories in London are nearly drained, and the short sellers who've been keeping a lid on prices are being squeezed. When it comes to gold, Piepenburg says we're witnessing something even bigger, a structural monetary reset. Central banks are quietly replacing U.S. treasuries with physical gold as their core reserves. That's not speculation, it's a realignment of global trust. The retail crowd hasn't even joined in yet, which means the main phase of this move may still be ahead. If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that actually understand what's unfolding. Thanks for watching.
And even Egan and I were talking this morning. Be careful you ask for when gold gets to 4,000, 5,000, 7,000. That's great for us who've had the foresight to understand sound money and gold as an insurance against fiat money. But it's very bad for the rest of the world. But what we're seeing with gold isn't just another commodity trade. This is a systemic change in global markets. It's more than a commodity trade. It's a monetary metal becoming the new strategic reserve asset beyond the U.S. Treasury. And for that reason, central bank demand is clearly the key driver behind these gold prices. It doesn't even include retail demand, which is barely catching on. I mean, gold is still 5% of global allocations, or excuse me, 0.05, so 0.5%. The historical average over the many decades has been 2%. It reached 8% in the 1980s. So gold hasn't even begun to hit the retail markets. It certainly has in China. ETF purchases in China have gone from 15 billion last year to 60 billion this year. That's just the retail market. But U.S. markets have not caught on. Even the Morgan Stanley recommending 60-20-20 now instead of 40% bonds is 20% gold. That's remarkable for a whale like Morgan Stanley to finally confess that. But the average man on the street, for many reasons, can't afford it or hasn't thought about it or hasn't been told that by their wealth advisors that gold matters. They've been told for 25 years that gold is too volatile, where it's outperformed the S&P for 25 years and even the last 5 years. So there's a lot of catching up to do by the retail side, but I think the fact of the matter is that it's the central banks that are driving that should be more concerning, because we haven't even gotten into the retail trade. And when that happens, gold's only going to go higher. People say, silver is the poor man's gold. I've always said, no, it's the smart man's silver. Yes, it is. I do understand for many people an ounce of gold is out of reach, and that's frustrating. And I'm very aware of that and sensitive to that. But $52, $60, even $100 silver is not out of reach for most. And I do think, as Rick Rule said, silver rewards infrequently but extravagantly, and we're now just seeing silver do what it does best when there's a gold bull market. I think the gold bull market is just starting. That's why silver is starting to do what it does best, that little speedboat that races past the juggernaut of gold when gold's in a secular bull market. And that's what we're seeing. And there's a lot of reasons why. Now, again, I was talking about this with Alistair this morning. Silver is massively undervalued, as all commodities are. Really, even pork bellies, wheat, and oil is undervalued and measured against gold. We don't see right now at 80 gold-silver ratio, the kind of compressed gold-silver ratios we saw in 1980 or 2011 was at 15 or 32. But I do believe that silver is going to be, when you look at it at its all-time high at 50 prior to these current highs, if you were to inflation adjust those prior $50 highs, gold should be at least at 150, which I definitely see it going to that. So if you're patient and you're buying silver for the right reasons, not as a day trade to see what it does in the next 6 weeks, and if you hold it, it will give you that extravagant, though infrequent reward. And I think a lot of investors who feel like they're missing out on protecting their paper money dying by having precious metals, they still can afford silver. We have a lot of clients right now who have the means to buy both gold and silver who are buying silver because they see a massive price appreciation in it. I think for retail investors, that's a huge play for them. There are clear supply deficits in silver. The entire silver market is half of Nvidia's market cap, so it doesn't take a lot of new demand to push the silver price up. And the ability to manipulate silver on the COMEX or LBMA markets just isn't what it used to be 5 years ago when there was legalized price fixing in the COMEX or London exchanges. Look, there was 80,000 silver contracts short on the COMEX recently. That was a massive short position, and still silver was able to peak through. And the COMEX is running out of silver to continue to make those price manipulations. The London float of available ounces is only about 155 million ounces, and that's a day's worth of trading. So the paper manipulation, the cartel in London and New York is breaking. That's very good for silver as well. In the past, there was the manipulation on the futures contracts on the LBMA and COMEX markets, and then there was a huge dumping. First the shorts, then the dumping. That happened in '81 when Gordon Brown was selling gold at 270 for his country, which is a disaster. But again, you've got a 45-year cup and handle, on the technical side for silver. You've got a clear supply side deficit on it. You've got a clear momentum trade in its favor. And you got it massively undervalued in terms of gold. So I think silver is an incredible fat pitch for people who want to get in the precious metal space who can't afford $4,200 gold right now.
The past year's rally in gold and silver might feel sudden, but as Matthew Piepenburg puts it, the move was inevitable. The pace surprised people, not the direction. Even at record highs, both metals remain undervalued because their real function isn't speculation, it's protection. As long as governments keep printing money to finance unpayable debt, fiat currencies will keep losing purchasing power. Gold isn't rising, it's the yardstick revealing how fast paper money is falling. Piepenburg says the heart of this story is the US dollar, still the world's reserve currency, and for that reason the world's greatest vulnerability. For decades, the US has expanded its money supply through deficits, credit, and central bank intervention to fund growth that isn't sustainable. Each time the dollar gets weaker, in real terms diluted like wine mixed with water. He points to history as proof. In 1933, FDR devalued the dollar by nearly 70%. In 1971, Nixon severed its link to gold entirely. By 1985, the Plaza Accord devalued it again to fix trade imbalances. Every cycle ends the same way, with currency debasement used as a short-term fix for long-term problems. And each time gold quietly reclaims its role as the only money that can't be printed. Let's get back to the interview.
If you understand gold in the context that we look at it in terms of history and the math of debt and the history and the math of credit cycles and the history and the math of unsound money, gold will stop making a secular rise when sound money returns to the sovereign nations of the G7 in the East and the world in general. And since I don't see that anytime soon, gold will continue its secular rise. It never moves in a straight direction. Frankly, we're all surprised by the speed of the last few months, or certainly the last 12 months in general, but we're not surprised by the direction. And I think even at these nominal prices, gold is still very undervalued, and so is silver. So to answer your question smugly and flippantly, but honestly, gold will continue to rise because fiat currency debasement will continue to rise as well. In other words, fiat money, paper money, debased money to monetize unsound and unsolvable debt crises will continue to be debased. And as a result, gold will continue to rise. Gold's doing nothing but do what it always does, hold its value while paper money loses its value. The dollar is an important theme when you're understanding precious metals, and the dollar is world reserve currency, so it's the most important currency to talk about, not just because I'm an American or just because I'm based in Europe. I'm not just focused on the dollar because it's my currency. It's a very important global currency. And because the dollar is used to monetize unsustainable debt, it has to be debased. When the M2 money supply is expanded, when central banks like the Fed print money, and when banks extend credit, that increases the money in circulation, and that's a deflationary an inflationary force. It's a debasement force. The dollar is just being diluted like a beautiful glass of wine with lots of mineral water being tossed into it quarter after quarter. So the dollar gets diluted, but because it is the world reserve currency, because of the milkshake theory and that big straw-sucking sound from the rest of the world, there's still demand for it. The inflation can be exported as it's been for decades, but at some point the jig is up. And again, when you look at the dollar, it's only being debased because it's being used to monetize debt that's gone out of control. So the dollar and the debt and precious metals are all kind of in a circular loop. And again, this is just history. David Hume, the Austrian school, Thomas Gresham from the 1500s, Adolf Thiers in the 18th century, Robert Triffett in the 1960s, Charles Goodhart in the 70s. It's certainly nothing new. This is just a cycle. The current headlines confirm that the dollar is being debased. The BRICS de-dollarization, the DXY, central bank since 2014, net stacking gold and net dumping U.S. treasuries. The petrodollar moves outside of the dollar. The COMEX fanatics and the gymnastics there. The BIS making gold a tier one. The IMF talking about gold in 2021, and 3 years of central bank gold stacking at over 1,000 tons per annum. This is the first time since 1996 that central banks hold more gold than U.S. treasuries. And of course, even Judy Shelton is talking about it. Morgan Stanley has a 60-20-20 now allocation, Mike Wilson. The desperation of the Genius Act. These are all signs of a dollar in decline or a dollar being pushed to the side in favor of a better strategic reserve asset, a better store of value globally, central bank-wise, and even at commercial bank levels. The dollar is just slowly but steadily being replaced by physical precious metals like gold. And in the devaluing of the dollar is nothing new. We did it in 1933 when FDR in an executive order overnight revalued gold from $20 to $35 an ounce. It's a 69% devaluation of the dollar. In 1971, when Nixon jumped off the gold standard, within 5 to 10 years, the dollar lost 90%. It's lost 99% since measured against gold since 1971. In my lifetime, the Plaza Accords in 1985, we devalued the dollar again. So devaluation, debasement to monetize debt isn't a gold bug case. It's an historical confirmation. And we see that it's affecting the markets. It's certainly affecting the gold price and the silver price. And it's really chapter 2 in a long, long novel of currency debasement to monetize debt. And I don't think gold's going to get any lower. It doesn't move in a straight line. Believe me, there can be retracements. I've had this debate with Brent Johnson, Henrik Zeberg, not declaring victory because the DXY is not at 100 yet. And there could be a last dance for the DXY, which we can talk about. But the dollar is simply losing purchasing power because it's oversupplied, overextended, and less trusted and less credible. Well, certainly on a relative basis, when you talk about the DXY versus other currencies, it's still the strongest horse in the glue factory for so many reasons. Because of its role in FX reserves, because of its role, it's 80% of global trade finance, it's $13 trillion in global debt, even if it's not due to U.S. banks, is in dollar denomination. And there's massive euro-dollar demand for the dollar outside of the U.S. and over 90 trillion FX swaps. So the dollar is still king relative to other currencies for now. But what's happening is that the dollar, and because of the dollar and the U.S. Treasury are so linked, and because the U.S. Treasury is so overissued and distrusted and weaponized since 2022, that was a turning point. The world is looking for a safer store of value. This term of art that we've been talking about for years is now making the headlines finally. They'd rather save in something that holds its value and spend in local regional currencies or fiat money. And that's why they're choosing gold, not just because the BIS told them to, but because they understand history too. If you and I can see these trends, believe me, the central banks of the East and certainly in China and the BRICS see it as well. And again, we're not seeing the death of the dollar or the end of the dollar. We're just seeing a repricing of the dollar and a slow loss of its hegemony. Again, this goes from the de-dollarization themes of the last 2 years to now the headlines making the gold market so popular all of a sudden. It's been clearly on our mind for a long time, but this is now history coming to its fourth turning. And the dollar will still have a role. It just won't be priced in the same way, traded in the same way, trusted in the same way, stockpiled in the same way as it was for decades before. And we're seeing that everywhere in the headlines now. It's not just a gold bug case.
What's unfolding now feels less like a bull run and more like an awakening. Decades of financial engineering and artificial stability are giving way to something raw and real, an economy rediscovering the value of scarcity. Silver, long treated as an afterthought, is emerging as the quiet gauge of trust in the system. Its supply chains are thinning, inventories are shrinking, and the illusion of control built through paper contracts is starting to unravel. Meanwhile, gold is reclaiming its ancient position not as a commodity but as the measuring stick of truth. Central banks know it, and their steady accumulation shows that the real monetary shift isn't coming, it's already here. The irony is that while headlines obsess over stock charts and quarterly forecasts, the deeper reset is happening in ounces, not percentages. The next phase won't be defined by who chases momentum but by who understands permanence. In a world built on leverage and promises, the assets that can't be conjured out of thin air are quietly taking center stage. If this silent rotation of wealth from paper to tangible value continues, how long before the rest of the world realizes that silver and gold aren't soaring, they're simply exposing the true cost of a diluted dollar? So stay tuned. If you're into real, data-backed takes on the financial system, hit like and subscribe so you don't miss the weekly updates. Thank you for the support, and I hope you enjoy the video.